Hey guys, so today I want to talk about some fundamental stuff for retirement math. And retirement math can be pretty complicated, so I want to start in a simple place, an easy case, which is just that there's no investments, the person's working a salaried job, and I want to take a look at what that behavior actually looks like. It might seem too simple to go through in detail, but there's actually a lot of interesting stuff, and it's going to build up into a broader story for inflation, for withdrawals, for exponential growth, all sorts of stuff. So let's get started. All right, so let's say you have two axes. You've got your capital and money, and you also have your time. And basically you start at some initial value, let's call it I. And then, if you zoom out, if you look at like how your capital grows or declines over time, and this could be due to any number of factors. It could be due to investments increasing or decreasing in value. It could be because of like spending habits. It could be because of salary. It could be of any number of reasons that this line is going up and down, but it's basically a measure of like how much money you have, right? What I want to focus on today is specifically what happens when you zoom in and what's the behavior of this line, especially for the case of a non-invested or salaried person, to kind of contrast that case with invested cases or more complex cases later. All right, so here we've got the graph again. We are basically coming in from the zoomed out region that bounces around, that looks really noisy. And we're going to zoom in all the way until we can see exactly what that line is doing. So if we zoom all the way in, and its initial behavior actually, when you zoom in, is that it stays constant. And why is this? Well, if it's not earning any sort of interest, if it's not invested, we can assume for simplicity that it's not doing anything. It's just sitting there. Its nominal value will stay constant. So this is for the salaried or non-invested case. Basically, there's no significant growth of this asset if it's just sitting around. All right, so let's say at some time T0, could be any time in the month, in the year, whenever, basically some amount is taken out, so it goes down. And after the money is taken out, well, since it's not invested, since it's not earning any sort of interest or income or dividends, it's basically just going to sit there. And let's say there's two more contributions after that. So you can see that basically this initial zoomed out line that was bouncing around seemed kind of random. What its local behavior is that it's entirely dependent on the person's actions. It's entirely dependent on whether they withdraw or whether they put in money. Now, this is not super interesting in and of itself, but it's going to connect to a broader point. So the first thing to mention is, let's say there's some sort of net contribution per month or per quarter. So there's not any sort of deficit. There's basically recurring contributions. This is a pretty common situation for people who are salaried or working. The idea is that you have some sort of net contribution that's recurring every month whenever you get paid, or every 2 weeks, or whatever the period is. So let's call that contribution C. And we basically get some net contribution per month, per year, per period, whatever it is. The important thing is that as we look at each one of these periods, what's the actual trend of where the money is going? And the trend is that it's a line. It makes this linear trend. Okay, so if there's a net contribution C per month, we basically get this dotted line. All right, the money that is coming in is contributing in such a way that it's growing in a line. Okay, so what does it really mean for capital or for money to grow in a linear trend? And one way to visualize this is we draw the dotted line. This is the trend that we had before. And then we basically mark out equal periods or equal intervals under this line. So for example, like let's say the person's working for 1 month, and then you want to compare it to a different month. And basically the idea is, if you take 2 different months and the person's salary hasn't changed, or their rate hasn't changed if they're a consultant, the areas underneath each of these regions is going to be equal. And so what that means is that as they move through time, basically the amount of money that they earn per unit of time is the same. It's a constant. Notably, they have to be working for that to be true, right? So one way to visualize it is you can make an arrow, and you can see like every little bit of time, every little step of time, there's like a little piece of money. We can call it M. And every little bit of moment, they accumulate an M. They accumulate a bit of money. And so this would be equivalent to you're walking down the street and you see like a row of quarters and they're all spaced equally apart. And, you walk every 4 steps and you pick up a quarter. You walk every 4 steps, you pick up a quarter. You walk every 4 steps, you pick up a quarter, right? So like the example demonstrates that as time moves forward, the rate at which you're getting this money is constant. So one important thing to mention is in this graph, basically for this person who is working, if they're not bringing in any money, either they get injured, they stop, they quit, whatever, there's no interest or dividends or income or growth of the money because it's just sitting in some bank account that has a trivial interest rate, something extremely low, assumed here to be 0. Okay. And what that means is it's constant if the person's not working, right? So, the phrase time is money is actually not true here. Here, time is actually worthless because as time moves forward, there's no accumulation of additional capital. It's basically entirely due to the salary. It's entirely due to the money that's brought in by the person's labor. So time is only worth the money that they bring in when they're working. If they're sitting around at home, they're not working. I guess you can consider like a salaried job over that year to be like linear growth, as we talked about, but like the money itself isn't doing anything. So it's entirely due to their effort that the money, that the trend line goes up and it goes up at a linear rate, as we discussed. So one objection that someone might bring up is, what about raises? What about rate increases? So if you've got your existing trend line, which is a line, and again, this is net, so every month there's some sort of net contribution, C, and it's going up in terms of a line. And then let's say the person gets a raise. So once the raise happens, you get a rate increase. You get an increase either in salary or you get an increase in basically the rate at which you get paid per hour. It's still per unit time, right? You're paid a constant rate per unit time. That's the whole deal. So in this case, let's call it C+, and C+ is greater than your previous contribution C. So what happens is the line that we had before, its slope increases. It gets steeper. So the rate at which the money is increasing has increased, yes, but the shape of that line is still a line. Okay, so what's the point here? The point is that for non-invested capital, people who are salaried or contractors, they accumulate capital at a constant rate. So again, back to the image, you've got a person walking down the street, and there's a quarter at every 4 steps, every few steps. They pick up that quarter and they march off into infinity, and they've got, a certain amount of money that they're getting per time. That's what a constant rate means. And so in order to get more money per unit time, the worker, the laborer, relies on rate increases. So they have to get a salary increase, they have to get a hourly wage increase, and that's how they end up getting more. But the shape of that growth remains unchanged. It's always a line. So they sell their time for money, and the rate at which their time is valued is always the same. So even though you're getting more experience, even though you might feel like you deserve more money, or there's inflation in the background, or there's changes of the values of goods, maybe the stock market went up, all sorts of different factors. Well, it doesn't matter for people who don't have significant invested assets, or for people who aren't making money on their money, if they're not basically getting any return on their capital. That's what the assumption in this video is that, simplified assumption, you've got some amount of money and it's not making any money on itself. So the only thing that the person can rely on is the contributions, and that will basically make a line if it's done at a constant rate. So obviously this is a really simple example, and it's kind of a toy example. So there's a few questions here. One question is, well, what about exponential growth? When you get, the kind of the classic compound interest question. What about inflation? Okay. What does that do to the value of money over time, and what can the person do about it, basically? What about withdrawals? So what if the person wants to retire, and they are withdrawing over time at different rates, or maybe at variable rates and so on? How is that gonna affect the development here, and what happens ultimately to the shape of these curves, the shape of the trend of what happens to the money? So those questions are going to be addressed in the other videos in this series. I want to take a step back and think about more broadly what this means in the larger picture. So obviously, most people aim to have investments. Most people aim to have capital that produces some sort of passive income or growth for themselves. So this example is simplified, but it's simplified so that we can get an understanding, a foundation of what the baseline is, so that we can see what happens to money when we're in the simple case, so that when things get complicated, and I'm going to make things pretty tough later, pretty more detailed, we have a foundation to stand on. We have something to reference. So if you want things to be, technical, if you want things to have lots of equations and describe the shapes of these curves and stuff, we can do it. And I'm going to make videos about that too. So, all right, if you stayed to the end, thank you for watching this video. I hope you got something out of it. If you have any questions or comments, please put them below. Last thing is disclaimer. This video is not financial advice. Everything in this video is for education and entertainment purposes only. Please seek a financial advisor or professional in your jurisdiction. Thank you.